Hello, good morning, ladies and gentlemen. At the onset, I thank you all for attending our webinar today. The webinar is correctly called Demystifying Transfer Pricing within Singapore. As we're all aware, there have been significant developments in the transfer pricing space across the world. And rightly so, because there has been a significant focus of the various government authorities on ensuring that their tax base remains consistent and profit shifting through transfer pricing mechanism is avoided. Singapore has also made a lot of strides in their transfer pricing initiative in the last few years. While Singapore started a bit late in the day on their transfer pricing endeavors, they have now caught up with the rest of the world, especially so over the last 4 years through a significant number of e-tax guides that they've released to give clarifications and to give a lot of guidance on transfer pricing matters within Singapore. Our panel today comprises of transfer pricing experts, which is largely Hai and myself, who look after the transfer pricing matters at Grant Thornton, Singapore. As you all would appreciate, transfer pricing at the end of the day is just a valuation mechanism and a valuation tool. The true impetus and the true impact of transfer pricing is always administered through corporate tax and GST matters, which is why Hai and myself are also accompanied by our corporate tax leader, that's Engmin, and our GST leader, that's Jeremy, who will take us through today's session on transfer pricing matters. The agenda today starts with an overview of the various transfer pricing legislation and the guidelines in Singapore. We will sort of focus on the 4 e-tax guides that have been released by our IRAS over the last couple of years or so. We'll then sort of go through direct tax and indirect tax perspectives vis-a-vis transfer pricing matters. And we will end with taking question and answers. With that little bit of introduction, I will hand over the mic to my colleague Hai, who will take us through various transfer pricing regulations.
Thank you, Munja. Hi, everyone. Now I would like to give you a brief on the development on transfer pricing legislation in Singapore. As Munja just mentioned, before 2006, transfer pricing and arm's length principle were not really an area of concern for both Singaporean taxpayers and the Inland Revenue Authority of Singapore, IRAS. Up until 2006, IRAS has introduced the first transfer pricing circular, which is introduced the basic transfer pricing information, including the arm's length principle, the transfer pricing methods, and a list of information required for transfer pricing documentation. However, it is noted that that TP circular mostly focused on the concept of mutual agreement procedures, MAP, and advanced pricing agreements, APA. And it is with the aim to have the taxpayer to defend their positions in case of any international transfer pricing disputes. It is also a message that Singapore wants to convey to the world that Singapore is really a good treaty partner. And we'd like to note that the TP circular at that time did not really have the force of law.
I think Hai is absolutely correct. The initial circular was largely to accommodate MAPs and APAs, which largely related to disputes outside Singapore that impacted Singapore, and to ensure that our taxpayers or a large number of MNCs having presence in Singapore could actually go in for MAPs and APAs, you required a sort of framework that could enable such MAPs and APAs. And friends, I think it's imperative to know that at that stage, there wasn't a very significant focus on transferring in Singapore because the entire mindset or our thoughts were that Singapore being such a pragmatic jurisdiction and having a very effective tax rate, ideally there really wouldn't be too much incentive to sort of shift profits out of Singapore. But as my colleagues will tell you during this webinar, what has been happening is that our trading partners and some of the other countries within ASEAN have been strengthening their transfer pricing regimes, which is why Singapore has now been strengthening its regime itself to keep pace with the rest of the world.
And back to this journey, the period from 2006 to 2015, there's only few developments on the transfer pricing. And fast forward to the 2015, where the first time IRAS introduced the concept of contemporaneous transfer pricing documentation. And at that time, it seems to be applicable to all taxpayers because there's no threshold for not preparation of transfer pricing based on the revenue. In 2016, Singapore has become the BEP associate, and it is to indicate that Singapore is really willing to commit with the at least 4 minimum standards set by the OECD and the BEPS actions. And right after that, Singapore did issue the e-tax guide on country-by-country report. 2018 is really an important milestone in this journey because the 5th edition transfer pricing guideline would introduce the threshold of revenue so that some taxpayers do not need to prepare the transfer pricing documentation if their revenue is below 10 million Singapore dollar, and also is to introduce the consultation program. And it's very notable to say that Singapore has formally introduced transfer pricing rules in the legislation, the Income Tax Act, in 2018. And it is to put in place a legal requirement for the taxpayers to prepare the transfer pricing documentation and to indicate that there's a penalty for non-compliance with transfer pricing regulations. And in the last 3 years, IRAS also introduced to us several e-tax guides on special topics, which is the commodity marketing and trading activities, and guidance on transfer pricing considerations for taxpayers who are affected by COVID-19. And recently, it is the e-tax guide on the centralized activities in multinational enterprise groups. And for this session today, we would like to focus on the e-tax guide and also the 3 e-tax guides that recently issued by the IRAS. Let me start it with the 5th edition transfer pricing guidelines. It's really a quite comprehensive guidelines which cover quite a lot of transfer pricing issues. First, it is about the concept of arm's length principle. Then it is about the related party definition and the transfer pricing methods. Also, IRAS provides us with the guidance to apply the arm's length principle in a 3-step approach. And last but not least, there's the requirements to prepare the contemporaneous documentation on an annual basis. Now start with the arm's length principle. Actually, it is a really international standard to guide transfer pricing. And basically, it requires a transaction with a related party to be conducted under comparable conditions and circumstances, as if it was between 2 independent parties. From this definition, you may see that there are 2 folds of arm's length principle. The first one is about the pricing of the transaction. It should be the real value or the real price of the transaction and should not come out from the thin air. The second fold is about the conditions and circumstances, which is a premise where the market forces really impact the terms and conditions of the transaction. The market force is really the best way to allocate the resources and to reward the effort spent. Now, next would be the definition of related party. You can find this definition in both the Income Tax Act and the 5th edition of Transfer Pricing Guidelines. Related party commonly is can be understood as two related parties who in which either person directly or indirectly controls the other person, or in another case, both parties are indirectly or directly controlled by a common party. What I want to emphasize here is there's no specific definition of the control. The important thing that I want to make is we generally look at the related party transactions from the shareholding perspective to determine whether the parties are related or not. But the concept of controlling are much wider than that. So the controlling can include the management participation or the management decision role, or even the main supplier of goods or services.
Absolutely, Hai. I think the word control is used very broadly, and I think it's extremely important to understand that transfer pricing, after all, is an anti-avoidance provision, and hence one will need to look at the actual conduct of parties and the substance of the relationship between two parties, rather than, like, purely going by the form of the transactions to determine whether two parties would be considered related to one another or not.
Now, with the next slide, we will go with the transfer pricing methods. Singapore has adopted the same 5 transfer pricing methods that OECD provided in the OECD guidelines, which is the comparable uncontrolled price, resale price method, cost plus method, transactional profit split method, and transactional net margin method. It is noted that there's no preference of methods as prescribed under the Singapore transfer pricing guidelines. And in fact, the taxpayers can choose to use more than one transfer pricing method to analyze and to determine the arm's length price for their transactions.
It's imperative to note that apart from the 5 prescribed methods, there are other methods available, which would be any other method which is reasonable enough to provide a sense of the arm's length price. Because while some of the typical transactions which relate to sale of products, provision of services, interest on loans, etc., can be measured using the methods that are prescribed, either CUP or the RPM or the TNMM, etc., etc. There are certain very peculiar transactions that exist where none of these methods would be applicable. For instance, let's look at a sale of an intangible product, or if you look at sale of shares, or certain specific industries such as oil and gas, where there are rigs which are leased from time to time. It would be very difficult to apply any of these methods, which is why the other methods or any other approach can be used, such as valuations under the DCF methodology, or using certain quotations from trade magazines, etc., can also be relied on in such situations.
Thank you, Punjab. Now back to the 5 prescribed methods under the TP guidelines. Each of them has its own applicability because each of them has its own advantages and disadvantages. For example, for CUP, we usually use it for traded commodities, while the resale price method would usually use for resellers or distributors who do not really add value to the product traded. The cost plus method would be used mainly for the manufacturer to convert from semi-finished goods to finished goods, and the profit split only be used if the transaction involves unique intangibles, and the interaction between the parties within the transaction are so integrated, and we cannot test it separately. And the last transaction is TMMM, which is considered as the most commonly used because it can be used for a wide range of transactions from the services to manufacturing, distribution, and even for some financial transactions.
Absolutely. And I think it's imperative to note that, like, the first three methods that Hai mentioned, that's CUP, which entails a price to price comparison, or the RPM and the CPM, which entail a comparison at the gross margin level, would generally provide the most accurate results or the most accurate measure of what would constitute the arm's length price. However, in reality, the comparability required for adopting these methods is highly strong, and the comparability needs to be highly accurate, which is why in practicality, in a large number of cases, the taxpayer ends up using a transactional net margin method, which is a lot more flexible to the degree of comparability vis-a-vis the above method.
Yeah, in this slide, we noted that IRAS introduced the three-step approach to apply the arm's length principle. In the first step, which is comparability analysis, we will focus on the four aspects, which is the contractual terms, which are relating to the pricing of the transactions, the roles and responsibility of the parties. Another aspect is the characteristics of the goods, service, or tangible properties, because it's really impact to the price of the transaction. And other aspects like functional analysis or the commercial and economic circumstances are those which we will look at for our analysis. And beside that, we have other four factors that we also need to consider. For example, if we need to test the transactions on a separate or aggregate basis, because the IRAS recommend us to do the test on a transaction by transaction basis to enhance the reliability of the analysis, or the multiple year data to reduce the distort of the data for a particular year, or whether we should choose the loss-making comparables or internal or external comparables. When it comes to the step 2, which is to identify transfer pricing method and test party, as we just mentioned in the previous slides, that 5 method, and we will base on several factors like the functional analysis, the conditions of the transaction and the availability of the data to conclude which method would be the most appropriate one. And when using the resale price method or cost plus or TMMM method, it is important for us to choose a tested party because we need to choose the less complex functions party to increase the reliability of the analysis. And the last step is to determine the arm's length results. And with this one, we are recommended to use the interquartile range so that it would provide the most precise result. Now I will move on to some key requirements to prepare the transfer pricing documentation. It takes effect from the financial year 2018, and it applies to the taxpayer who has a gross revenue of more than 10 million Singapore dollars for one financial year, or those are required to prepare the TP documentation for the previous years. Also, there are some exemptions may apply to, for example, some specific threshold for transactions like the 1 million Singapore dollars for service transactions or 15 million for sales or purchase of goods or provision of loans. The TP documentation should be put in place by the due date of the corporate tax return, and for the year of assessment 2021, it is the 30th of November. The TP documentation is not really required to be submitted with the tax return, but need to be ready, put in place, and should be submitted to the tax authority upon request. And very important to note that IRAS want to share the burden with the taxpayer, so that IRAS allows the taxpayer to prepare a simplified transfer pricing documentation instead of a full-fledged one for some certain case where there's no significant changes to the functionals of the company, as a Singapore company, and there's no change to the participating parties as well as the transfer pricing policy. Now, when it comes to the information that you need to include in the transfer pricing documentation, there are really three levels of information. The first one is the group level, in which you have to disclose the organizational structure, some information about the group business, their product, service, even the key competitors, the supply chain, and business drivers. Even we have to include the intangible assets and financial activities, if any, in relation to the group activities, and also the overall transfer pricing policies. When it comes to the entity level, it is quite similar to the information that required for the group level, with the structure, the products and service, the competitors, the business model and strategy. And also for the transactional level, the taxpayer are required to disclose a lot of information about each transaction, including the related party, the relationship between the two entities, the values of the transaction, the agreement of the transaction, and the TP policy in this.
Right. So the entire endeavor and the reason relating to the contents at the group level, entity level, and the transactional level is to sort of get a sense of what is the entire value chain within a particular MNC group, where within the value chain does the particular taxpayer lie, and how the transaction interacts with the value that is being created by the group and the entity level, and how this impacts the particular transactions that have been undertaken by the particular taxpayer. So that's the entire endeavor based on which the documentation contents has been framed. And it's imperative to note that while this is largely in line with what the OECD regulations require, the documentation requirements within Singapore for the local file or for the TPD, as we call it, is a lot more significant than the rest of the world, because since Singapore does not have a requirement for the master file, a large part of the contents of the master file are covered within the local transfer pricing documentation.
Yeah, now I would like to give just a brief information about the country-by-country report. IRAS only required the taxpayer, who is an ultimate parent entity of a Singapore MNE, to submit its country-by-country report if the gross revenue of the whole group is more than 1,125 million Singapore dollars. And the information in this report is mainly figures like the group's revenue, the profit, the tax, and economic activities. Now, you may have a question: after all of these requirements, what is the penalty that may be imposed? And there are two layers of penalties here. The first one is in case the taxpayer is considered as non-compliant with arm's length principle, IRAS may impose a transfer pricing adjustment. And on top of that, a surcharge of 5% will be imposed as well. And the second layer of penalty would be for the non-compliance with transfer pricing documentation requirement. And it would be a fine to 10 million Singapore dollars in this case. And that's all for the first e-tax guide. I will move to the second one on commodity marketing and trading. Now, IRAS issues a set of guidelines to provide guidance on how to analyze the economic value and value change of commodity marketing and trading activities. based on the function performs, asset used, and risk assumed within this spectrum. We may have several characterization of entities in this value chain, like the service provider, agent, distributor, or full risk entrepreneur.
I think one of the reasons why there's a separate, so I mean, a lot of people may wonder why is there a separate e-tax guide for commodity products. One of the reasons that I fathomed that this was required was because, as we all know, Singapore is a very significant hub for commodity products. So a lot of the MNCs, whether it's oil and gas, whether it's iron ore, whether it's other commodities and precious metals, probably even cement, a lot of the MNCs who sort of deal in these products use Singapore as a hub for its trading activities. And that's largely because of Singapore having fantastic treaty network, being pretty close to the sort of customer base, and again, having a lot of flexibility for raising finance and a total lack of or an absence of exchange control guidelines. So that makes Singapore an extremely attractive hub for housing its commodity trading operations, which is why, because there were various forms within which the MNC set up their Singapore hub, it was imperative for the tax authorities to provide guidelines on how to sort of the various models that could be structured for these hubs, and for the various models, what kind of pricing arrangements would be feasible.
Then based on the intensity of the functions of each characteristics we do in the day-to-day operations, there would be different methods that we can use. Like for service provider who will mainly provide the market research, where there's no risk relating to the commodity, we can use the cost plus method or the TMMM method to determine the remuneration for the service provider. When it comes to the agent who will only act on behalf of the supplier and do the marketing role, the CUP method can be used to identify the commission rates. And for distributor who really do the purchase and sales activities, we can use the resale price method or the TMMM with operating margin. And when it comes to the full risk entrepreneur who really engage in the full range of activities and take all risk like an entrepreneur, we can use the CUP method to find the quoted price of commodities or even the profit split in this case.
And it's important to know that these are just guidelines that have been provided by the IRAS. I mean, there's nothing hard and fast out here. At the end of the day, you've got to use general transfer pricing principles to sort of determine your transfer pricing. But I think the examples and some of the case studies that have been provided in this e-tax that are extremely useful. And I've known a lot of my clients who are sort of trying to set up their hubs in Singapore for commodity trading activities, actually sort of subscribe to these guidelines and use these guidelines for determining their business model. Again, another imperative point is, whilst these guidelines are largely sort of focused on the commodity products and commodity businesses, some of these guidelines can also be used for non-commodity product businesses to provide certain guidance on how one can structure their models, how one can set up their transfer pricing approaches.
Now it comes to the guidance on transfer pricing consideration amid COVID-19. It has been a year or over a year since COVID-19 hit us, and still a number of companies still facing operational and financial issues. And IRAS proactively provides this guidance to support the taxpayer to have a flexibility in defending their transfer pricing arrangements. In doing so, the taxpayers need to include some certain information in their transfer pricing documentation. For example, a broad analysis on the impact of COVID-19 on their industry and on themselves, or the functional profile pre- and post-COVID-19 implications. And it's very important that the taxpayer can provide the comparison of the pre-COVID-19 and the actual results of the P&L analysis, together with some evidence or explanation on the adverse impacts. By that, IRAS will have a better understanding on how COVID-19 really impact the taxpayer operations and business. And then IRAS also introduced the term testing approach, in which the taxpayer can use the multiple year average results instead of a single year testing. And this really allowed the taxpayer to conduct the economic analysis in a more flexible way. Also, the IRAS want to raise the awareness of the taxpayer to do their APA, not only for the new APA application, but for the current APA application and existing APA, so that the taxpayer really need to consider whether they consider the certainty of the business, or and is there any impact of COVID-19 that they haven't aware and estimate before, or any critical assumptions of the terms and conditions that they need to put in the APA. All in all, this guidance of the IRAS is really a welcome and positive guidance for the from the IRAS to the taxpayer.
I think, friends, I think the term testing sort of the guidance on term testing is extremely useful and extremely welcome. And one of the reasons for this is because very often the latest data is not available when you're conducting your transferring analysis. So very often you end up using your current year tested party data with the past year comparable data. And obviously that will not enable an apples to apples comparison. So it's only to enable such apples to apples comparison and sort of compare comparable periods is why the term testing becomes extremely useful and extremely critical for us.
And it is the fourth e-tax guide that I would like to bring up today on the centralized activities in M&E groups. The reason why IRAS introduced this one because Singapore was selected as the destination by a number of M&E to set up or establish their global or regional headquarters to manage or to control the global or regional activities and operations. This guide can be used not only for Singapore-based headquarters, but other entities in Singapore who provide centralized activities. And you can see that this guide really focuses on the group profit drivers and the overall value chain of the group in relation to the Singapore headquarter positions. And it's really helpful for us to refer to this guide to determine whether the Singapore headquarter sit in their value chain, whether they are entrepreneur or just a service provider. In this one, we can see that there are a number of operation types and can be grouped into four main operational types. The first one is the one with very complex activities, who is a principal in distribution, manufacturing, or even research and development arrangements. And in this one, the Singapore entities really undertake the risk of decision-making responsibility and really act as an entrepreneur. And in this one, we may choose based on many factors like the availability of the data or the intensity of the functions to see whether the method, the cut method, or cost plus or TNMM can be used in this case. For another type, like the core business processes, Singapore entity can manage critical business risk for the whole group. However, the risk profile here would not be too high, as in fact it is merely assist the group. And in this case, we can choose to use cut method, either the profit split method or the TNMM. For the activities in more like the coordination type functions, the Singapore entity will really support the running of the group entities and bear limited risk So in this case, TNMM or the cost plus method can be used because the value of the service really driven by cost. And last but not least, there's some activities like the shareholding activities, where the Singapore headquarter entities will act and benefit the shareholders instead of the group entities. And in this case, different from other central activities, there should be no charge back from the Singapore entities to other group entities.
Again, these are like just certain guidelines and just certain indicative approaches that are being suggested by the IRAS. Once again, it's imperative that one looks on this on a case-on-case basis. You may have cases which don't fit into any of these 4 types of activities, and which is why sort of relying on the basic transfer pricing principle again becomes pretty imperative. With these, these are the 4 tax e-tax guides that were issued, which sort of provide a significant guidance on transfer pricing principles. How that emanates into direct tax and GST matters, I hand over now to my colleague, Engmin.
Thank you, Joe. Now, as you're aware, I mean, transfer pricing is just a mechanism, a pricing mechanism, a valuation tool that we use to basically identify and determine what's the correct price between 2 related parties. So once you've already determined that price, what do? So ideally, you should have put it through in your transactions, you know, with your related party. But in practice, sometimes your transfer pricing documentations may be ready after your year end or after a certain time, and you have got these transactions to be put through, adjustment to be put through. So if you need to make an adjustment, the question is, can you? Well, I mean, in practice, if it's an upward adjustment, IRAS wouldn't have much of a problem. They will just tax it. But if it is a downward adjustment, there may be some conditions that need to be met. Now, what are the types of transactions? I mean, adjustments that you could put through? So there are 4 of them. I will just run through them one by one. The first one is the year-end adjustment at year-end closing of accounts. Now, I mean, in Singapore, you're aware that your transfer pricing documentation will be considered contemporaneous if you get them ready by the filing, by the lodging of the return. And in Singapore, we lodge the return if, let's say, we have a 31st December year end, we would lodge the return by 11 months after the year end, which is like 30th November of the following year. So you do your transfer pricing documentation, then you realize that actually you should be charging X instead of Y to your related party. So in your accounts, you've recorded X, but actually from your transfer pricing documentation, it should be Y. So what do you do then? Can you make the adjustments? So, okay, you can make the adjustments if you have in place contemporaneous transfer pricing documentation, like what I've said earlier on. Have it ready at the point of your lodging of your return. And the second point is that whatever transfer pricing adjustment that you make, your end, it has to be symmetrically adjusted in the affected related parties books as well. And then of course, the last one is that you need to basically make all these adjustments before you file your tax returns. So if you meet all these 3 conditions, IRAS will either allow an upward or downward adjustment. Upward means they will bring you to tax, no? Downward means they will reduce your tax payable. So Singapore is one of those countries that actually allow a downward adjustment. Now, if you don't meet all these conditions, IRAS will merely just bring the upward adjustment to tax. So that's how it actually works for your year-end adjustments. Now, the next category of adjustment that I'd like to talk about would be your compensating adjustments. Now, these are for people who have entered into advanced pricing arrangement with the Singapore Revenue. There are 3 types of advanced pricing arrangement. It could be unilateral, so it's just one direction between the taxpayer, the company, and IRAS, or it could be bilateral, 2 countries, Singapore and another country, or it could be multilateral, which would involve more than one. So if you manage to enter into a advanced pricing arrangement, then if there need to be any TP adjustment to be made, whether it's up or down, it can be made. So, but I just said this is a caveat. It's not easy to enter into an advanced pricing arrangement. It can be a very time-consuming exercise to do so. Right. The next one that I would like to talk about would be what we call the self-initiated adjustment. Self-initiated retrospective adjustment. Let's say globally, your parent company has actually relooked at your transfer pricing policy. They realize that something is not quite right, in terms of the charging here in Singapore, or there's some differences, revision in your analysis, or you've already take a look and then you realize that you may have made a mistake in a transfer pricing adjustment. So in this case, you would like to self-initiate it and go to the IRAS and say that I would like to make an adjustment. And this one will save you only for the surcharge, because if you wait for IRAS to make the adjustment, there will be a 5% surcharge on the adjustment. But if you realize that whatever position that you've taken in the past cannot be supported with your transfer pricing documentations, you may actually go forward and then ask, and then basically tell IRAS about it and ask for the adjustment to be made. And in here, in this particular option, you can only do upward and not downward adjustment, which means to say there'll be additional tax payable on that adjustment. And the best you could do is save yourself, surcharge or some penalties that the IRAS may actually issue otherwise. Right. Now, the last one, which is that I'm going to cover, is this corresponding adjustments. Now, this one, there must be a DTA between Singapore and the foreign jurisdiction. So there must be a double taxation agreement between Singapore and that jurisdiction, and the DTA must have a provision for an MAP, which is the Mutual Agreement Protocol, and the companies in question must have already evoked the MAP for that whatever dispute, on that double taxation of certain items, and this has been accepted by both sides. So it has been accepted by both IRAS as well as the Foreign Tax Authority. Then you can make the the consequential upward or downward adjustment arising from the agreements that you have obtained during the MAP. This again is a very laborious process. It's not something that you can do it very quickly. I have seen very, very long drawn discussions between authorities over a long period of time. And by the time I left my previous firm, so I don't know whether they finished it or not, but I know it's a very tedious process when it comes to mutual agreement protocol. Okay. Now I'll just move on to employment tax next. It's another form of direct tax. Now, employment tax matters of employees that are involved in the provision of services for which the transfer pricing study may be on are usually neglected. So what I meant is this, okay, you do your functional analysis, you look at the number of employees that you have, the kind of work they are doing for yourself, for your related party, and then you work out a basis of charge to these related parties. But then, the question then is that, what are the roles and functions of this employee? Who are the employer on the record? So is it very clear in your agreement what costs ought to be allocated? And would you have allocated all the costs? What about, long-term incentive plan? Are there any? Is there like a cost to it that you ought to have charged down to your related party as well? And usually when you do your functional analysis, you may say, okay, estimated this person will be X number of days in Singapore, Y number of days outside Singapore. But in reality, when you come to really track it, is it like that or is it something else? So this probably the employment tax aspect would probably be more the operational issue, but these are the considerations that you need to take, you need to be aware of. So the other three balls where we have the withholding tax, payroll requirements, and tax reporting really boils down to the issue of whether the employee in question is your employee or an employee of a related company who has actually provided that service, and whether whoever has this obligation, this payroll obligations or tax reporting requirements obligation. Transfer pricing is really a transactional tax because you're actually looking at your related party transactions. So if this being a transactional tax, we cannot miss out the GST portion. I'll pass it over to Jeremy to talk about GST implication. Thank you.
Hi, thank you, Eng Ming. Thank you all for being here today. For those that haven't heard me present before, I do have a stammer, so if I do get stuck, please bear with me. As Amy mentioned, the ultimate net result of a transfer pricing adjustment creates a transaction in the company's accounts or through the tax return, and it would be incorrect to not consider the transactional tax implications from that. As Manjao, Engmeng, and Hai mentioned, there are a few reasons why a TP adjustment would need to be made. From a GST perspective, we just look at it from a simplified perspective. We would just consider whether the TP adjustment is to increase the value of a previous transaction or whether it is to decrease the price of the previous transaction from a GST perspective. And from a historic GST treatment, due to the lack of clarity and guidance from the tax authorities within Singapore, there was often a large amount of uncertainty as to how the transfer pricing adjustment should be treated. There were people that viewed it because it's an adjustment to a transaction which has previously been reported from a GST perspective, that it's not a taxable supply or a taxable transaction from a GST perspective. However, the IRAS have now clarified their position within an e-tax guide that they published in the beginning of November 2019, and that's we're going to go through the key takeaways from that e-tax guide on the next couple of slides. The first one is to consider, well, just because there's been a transfer pricing adjustment doesn't necessarily mean we have to make a GST adjustment. As I said, there are two types of TP adjustments from a GST perspective. The first one is where we're increasing the value of a previous transaction. And in this case, there are two conditions we have to check if they are met. And if either one of them are met, then we need to consider the TP adjustment from a GST perspective. The first test is whether the TP adjustment has been effected and included within the financial statements. And the second one is if the adjustment hasn't been made in the financial statements, but purely through the tax return that is submitted, then that TP adjustment needs to be treated as a taxable transaction from a GST perspective. The second type is the decrease in the value of a previous transaction. Now, within this situation, we actually have to make sure that both of those tests have been met. If it's a case that only one of the transactions, if it's a case of only one of the conditions was met, then we do not need to make a corresponding GST adjustment in respect of that transfer pricing adjustment within our GST returns. In its usual pragmatic fashion, the IRAS has actually implemented an administrative concession. Now, what they've decided to implement within practice is that if we look at it from a fundamental perspective, if the resulting GST adjustment in respect of that transfer pricing adjustment does not result in any net additional tax payable, in other words, if it does not result in any net tax revenue to IRAS, then they effectively grant a concession that the company does not have to apply the GST adjustment, even though strictly speaking, the TP adjustment is a taxable transaction from a GST perspective. Now, to consider the administration concession and to confirm whether it applies, we need to consider what is the nature of the TP adjustment that we are making. If it's in respect of a standard rated GST adjustment, then we would need to ensure that both of the conditions are met, and that is that you, as the supplier of the previous transaction, are entitled to full GST credit on your costs, and also that your customer is also entitled to full GST recovery. So within this situation, it would be you also need to confirm that your related party is also entitled to full GST credit on their costs. I think the key point to note here is that the administrative concession is on a self-assessment basis. However, the company needs to maintain documents to substantiate how it determined that both you and the customer are both entitled to full GST credit on your costs. The other two types of TP adjustments would be the zero rated and the exempt transactions, as well as the taxable imports. In those situations, you only need to consider whether you, the supplier of the transactions, are entitled to full input tax credit. You do not need to consider your customers or your related party status. And so if we've determined that the TP adjustment is subject to a GST transaction, and that the business does not meet the admin concessions, then the next step is actually to determine how we make the adjustment and when we make the adjustment. The pure nature of a TP adjustment can be that it's actually quite difficult to track the underlying transactions that you're actually rebasing the value for. However, the primary perspective is that in order to determine the GST liability of the TP adjustment, you would need to consider what is the category of the transactions that you're actually rebasing the value of the supply for. So for example, if the Singapore business was making a standard rated supply of goods or services, then the GST liability of the TP adjustment would follow that same GST treatment. Now, obviously, the complexity can come about is if we have a cost plus company, which is recharging back to their overseas related party. If they are providing support services directly to Singapore customers, but also to customers overseas, then the nature of the underlying recharge to the related party could be a mixture of standard rated and zero rated supplies. So in that situation, it can often be quite challenging for the company to actually go back to analyze the value of each of those different transactions. So the IRAS has implemented a concession where the Singapore company can use a proxy to apportion the value between the two different types of GST treatment. There are a couple of different proxies that IRAS have listed within their e-tax guide. However, those proxies are not exhaustive. You can also create your own if it's more appropriate than the pre-approved ones that the IRAS have included in the e-tax guide. The last point is actually to determine in which GST return should I account for the GST adjustment. So the GST treatment of the TP adjustments actually follows the basic time of supply treatment, and that is you need to report it in the period in relation to the earlier of the payment or the invoice that has been created in respect of the transfer pricing adjustment. I think one key point to note is that there is still a related party backstop provision, which is an anti-avoidance provision, which stipulates that even if a TP adjustment has been made, but an invoice has not been created or the adjustment has not been paid, then it is still brought to tax at the end of the year. And as you'll be aware, there's also an administrative concession where companies can elect to treat their or to report their purchase transactions on the invoice posting date rather than the actual date of the invoice. That rule also applies for TP adjustments. So that brings me to the end of the GST section, and with that, I'm going to hand back over to Munjar, who's going to manage the Q&A section of the presentation today.
Thanks a ton, Jeremy. And I hope this session was useful. I hope we were able to sort of communicate the various aspects that we endeavored to in the short time that we had. We've come up with, we've had some fantastic questions as I just go through the list. Let me just quickly start with the question that Richard asked on the master file clarifications. And Richard, you're absolutely right. The Singapore regulations do not require a taxpayer to maintain master file as such. However, the local file that the Singapore tax payer needs to maintain would need to contain some of the contents that would typically have gone into your master file. So yes, there is no requirement for a master file, but a large amount of information relating to the group's supply chain, its key transactions, its sort of funding, etc., needs to be covered within the contents of the local file that needs to be maintained by the taxpayer. I hope that answers your question. The next question is on I'm just reading it verbatim. Under what circumstances would a supplier be considered to be a related party? Fantastic question again. And very often we come across, say, franchise arrangements in the retail space, wherein a person who's owning a business is required to purchase, say, 100% or close to 100% of its products from another party, which may not have any shareholding interest or a common management. But because the relationship between the supplier and the seller in this case is so strong, and is the person who's selling the goods is pretty much dependent upon the whims and the fancies of the supplier in this case. And in such cases, even though there's no shareholding relationship, there is no sort of management relationship between the two, the very fact that the supplier is able to control the prices and drive the prices and pretty much like, drive the business of the seller, these two would be considered as related party, because there is a significant element of control that the supplier can place on the seller in this case. So again, there's no sort of thumb rule as regards the percentage, etc. You got to look at the arrangement in its entirety to determine whether there's a potential, there's a control, and whether the two parties can be considered to be related to one another as such. So it is again a case-on-case basis that we need to do the analysis. The next question again is on TPD, which talks about if the TPD is prepared by the parent company, under what circumstances would this be acceptable to Singapore? Fantastic question, and a question that has been often asked to me by my clients as well. What happens very often is when you have a global transfer pricing study, very often it's prepared from the perspective of the overseas entity, and a large part of the facts and the functional analysis of the Singapore entity is missing. Again, something that I'd alluded to earlier when I was responding to Richard was the Singapore transfer pricing guidelines have a few peculiarities that are absent in the OECD documentation requirements or in the documentation requirements in other countries. So if some of these contents are not there in the global transferring documentation, one would need to sort of adapt that as well. So I think what one needs to see is take a look at the transferring documentation that is maintained by the parent company at a global level or as per the requirements of their countries. See whether Singapore is appropriately covered within that documentation, whether the functionality, whether the transaction has been sort of measured from the Singapore company's perspective as well, and whether the various contents that are required to be maintained from a transfer pricing documentation requirement in Singapore is contained in that particular documentation before determining whether the global documentation can be used for Singapore purposes or not. Very often the documentation may be pretty much out there, say 50% of the contents may be there, etc. Then you can use that documentation and just adapt it for Singapore purposes. Again, the answer would be it's a case-on-case analysis that one needs to sort of perform. I've got one more question, which again I'll take, is that have you ever seen the IRAS impose a 5% surcharge? The answer to that is still pretty early days. You just got the first couple of years of transfer pricing documentation that have come through. The IRAS are still pretty much analyzing these, and hence we haven't come across too many cases or or I'm not aware of any case that the 5% surcharge has been put in place as yet. But my gut on this, to sort of give you some sort of comfort or to give you some just my prima facie thoughts on this, is that the IRAS is going to use this 5% surcharge very judiciously. So, I mean, any sort of adjustment that takes place may not be accompanied by the 5% surcharge. My gut is that the Singapore IRAS has always been very pragmatic and very taxpayer friendly. So only where it sees that there has been a very significant endeavor by a taxpayer to try to avoid taxes, or where, like, there's been, like, something which is pretty much malified that a taxpayer has performed with a view to evade taxes in Singapore, will the 5% surcharge be levied? Obviously, there may be cases where there may be a genuine sort of difference of opinion between the taxpayer in Singapore and the IRAS, and that may be very well documented in the transparent study. In that case, the adjustment should not ideally be accompanied by the 5% surcharge. So again, it's only where there's been a sort of mischief done by the taxpayer will the 5% surcharge come into play. I mean, that's just my thought, but again, only time will tell. Let me take this question on a short-term arrangement regarding the loan. I'll read out the question. If there's a short-term arrangement such as related party loan that took place during the year, and the loan does not exist at the end of the year, would you still need to maintain transferring documentation? Absolutely yes, because what happens is, even though the loan that was prevailing during the year, there's an interest that has sort of accrued and has been accounted in the books of account, and as a taxpayer, you'll be taking the benefit of the interest deductibility. So even though the loan may not subsist at the end of the year, the loan may all have been paid out, it is imperative to sort of value that the interest transaction to ensure that you're just claiming an appropriate deduction for your income tax purposes, and hence the transferring documentation becomes imperative. There's a question on GST, which Jeremy, would you want to take that?
Yeah, sure. So the question is, since there is no GST adjustment on the TP adjustment given the concessionary treatment that IRAS would allow, is it correct to say that GST adjustment on TP adjustments is a non-issue? In short, the GST adjustment is still an issue that the taxpayer would need to consider. I guess there's a couple of things that the taxpayers would need to consider. The first one is actually to make sure that they meet the administrative concession. And the second one would actually be to make sure they have the supporting documents to be able to evidence that they have made the correct self-assessment, that the admin concession does not apply. One of the challenges that taxpayers may have with that is that they know their own GST input tax position, but in respect of any standard rated TP adjustments, they also need to get supporting documents that their customer or the related party is also in a position where they claim all the GST on their costs. So to say it's a non-issue would not be correct. Although it may not result in any additional GST reporting or GST payable, there are still very specific documentary requirements that the taxpayers would need to make sure they adhere to defend that position should they be audited by the tax authorities.
I think since we're just running out of time, I'll take the last two questions now, and all other questions we will be glad to sort of answer them over email, or we can over a telephonic conversation as well. The next question is by Lenny, and Lenny's question is: would a 50% shareholder in a 50-50 JV be considered a related party? The control is split 50-50 with the other JV partner. The answer to this would be generally yes, because as you mentioned, there is a control between the JV and the JV partner, especially to the extent of the 50%. Yes, they would be considered related party in this case. And ideally, the transfer pricing would apply to a JV partner as well. The next question is from Albert. May I know how do we carry out a cup RPM comparable analysis? Can we rely on market TP Catalyst databases? To be honest, I'm not really aware of the TP Catalyst database as such, but just to sort of give you some perspective on cup is a price to price comparison, and hence the comparability has to be highly accurate. The product has to be exactly the same in this case. The terms of the transaction have to be exactly the same in this case. And also the functionality of the two companies or the two transactions have to be exactly the same to carry out a cup analysis. I'm not sure the level of data that you get on the TP Catalyst database, but if you are able to establish that the products are exactly the same, as well as the circumstances of the transactions are exactly the same, probably you would be able to. But just to sort of give you some sort of an example, you may have, say, a coffee transaction wherein, like, you're trying to use a price for a Brazilian coffee to compare with, say, an Indonesian Java coffee, and that comparability would not stand because the two coffee types are totally different, and hence the pricing arrangement for those two transactions will be totally different. Again, you may have a transaction for, say, 1 kilo of purchase, and the comparable could be 100 kilos, and obviously there would be volume discounts and different trade terms that come into play, and again that transaction would not be comparable. And hence the point I'm trying to make here is that you got to look at the comparability in granular details in this case, and which is why I feel using databases where you may not have the full sort of set of information may be a bit difficult to apply. But again, do take a look at it, and if you can get granular details, as I explained some time back, please go ahead and use that database. Yeah. With that, I think we will close our session for the day. If you do have any further questions, do feel free to email to us. We've got our emails here on this page as well. And I think we'll be sharing our recording of this session with the attendees very shortly. Feel free to reach out to us if you have any further questions. We'll be glad to help you. Thank you so much for attending. Good day, goodbye.